If you passed away yesterday, would your family get an eviction notice 3 months from today's date? Well, now we're going to talk about why it's important to think about the M in the dime concept. I'm Ericka L. Abrams. I'm the Gen X Wealth Architect. And today we're going to cover the M, which is mortgage. We've already talked about the D in dime, which is death and debt. We've talked about the I, which is income. And now we're going to talk about mortgage. Why is it important? Well, my first statement. If you were to have passed away yesterday, your family still needs a place to stay. Your investment properties still need to be paid, okay? The mortgage needs to be paid. It needs to be satisfied. And so it's important for all of us to consider our living arrangements, right? For our families. If a breadwinner passes away, then their income is gone. You want to replace the income. Now you want to think about how can you satisfy your mortgage debt so that your family does not have to deal with grieving the loss of a loved one on top of having to figure out where they're going to live. I've moved several times in my life as a college student, as a married woman, as having a family, and it's more than a notion. So just imagine a family that doesn't have provisions in place to take care of their living arrangements, and they have to scramble and figure out what to do, how to move, how to pack things up, and they're already grieving the loss of a loved one. You don't want to put your family through that. So you want to think about, number one, how much of my mortgage debt would I like to be paid in full, or what portion of it would I want my life insurance program to accommodate, okay? There's a lot of products, for instance, like a mortgage protection life insurance policy that can be aligned with the number of years that you have remaining on your mortgage. Or you can essentially just buy a term life policy that is enough to satisfy whatever amount that you want to be able to be paid down on the mortgage. Talking to your licensed life insurance professional or estate planner can help you figure out what's the best way to move with that. Most mortgages are 30 years. You're not going to necessarily want to pay this policy for a total of 30 years because as we make payments, the mortgage debt continues to decrease, okay? First few years of the mortgage is primarily interest and a little bit of principal, but as time goes on, more money goes towards the principal. I'm a licensed mortgage loan originator, so I understand this concept very clearly. Here's another tidbit. For those of us who buy a house, unless we put 20% down on that house, we have to pay mortgage insurance. Mortgage insurance is not for you in the event that you pass away, to help protect your family and keep them in the house. The mortgage insurance is actually for the bank, the lender who lent you the money to buy that house. That ensures that if you default on that mortgage, meaning if you foreclose on that mortgage, that they still get paid, okay? You're out on the street, but that bank still gets paid. If they think that it's important to have mortgage insurance on that loan in the event that you default, you need to understand why it's important for you to have mortgage protection insurance to protect your family in the event that a breadwinner passes so that they can stay in the family home. Or as I mentioned before, your investment properties can be paid off, or a large portion of the mortgage can be paid off to keep those properties in your family's in the portfolio so that they continue to monetize and profit off of your real estate portfolio that you've built to build generational wealth. Again, my name's Ericka L. Abrams. I'm the Gen X Wealth Architect. I help you understand how you can build wealth, protect health, and preserve legacy. In preserving your legacy, think about how mortgage protection insurance can help you to achieve the goals and keep your family on the trajectory to building legacy and generational wealth. Have a great day, and I'll see you on the next one.